Thank you. Okay, bye-bye. Okay, good morning, everybody. Welcome to San Joaquin County's Deferred Compensation Advisory Committee meeting. Today is July 30th, 2020, and it is 10 o'clock in the morning. So welcome, everyone. Thank you for your patience while we work through this process of doing this via WebEx, which is a different platform than normally where we meet together in one room. And this is Brandy Hopkins, a committee member. So the first item up is Donna Strange is going to take our roll call.
Good morning. Brandy Hopkins.
Here.
Jerry Becker.
Here.
Christine Babb.
Here.
Jay Wilverding. Jay, are you with us?
He's on mute.
Okay.
I see him.
Okay.
Jay, can you wave?
Yeah, I'm here.
Thank you.
Okay, there you are. Catherine Miller. Nancy Calkins. And Fonse.
Welcome.
Fonse, I'm sorry, I don't know how to say your last name.
Welcome. Here.
Kiakum, thank you.
Okay, thank you.
Before go, I do see Supervisor Miller there, but she is on mute. I'm sure she's working on it.
Here I am. I had to figure out how to get off on WebEx.
No problem,
There
Chair.
you are, thank you.
And then maybe we'll do one more try for Nancy Cole.
Nancy Calkins.
I don't see her. She could be here, but perhaps she can. Nancy, if you're here and having technical trouble, please reach out to Tammy with that number she provided. But otherwise, Madam Chair, I think we can proceed.
Thank you. Again, thank you, everybody. Welcome this morning. Just a couple of housekeeping items. If you can make sure to keep your phone on mute unless you are speaking. And if you need to take a call, please hang up and then dial back in if you are a dial-in, because if you put us on hold, then the music overpowers the individuals who are speaking. So the first agenda item number 1, is approval of the minutes of January 30th, 2020. And as a reminder, our April 2020 quarterly meeting was canceled. Are there any questions from the committee regarding the minutes that they received? If there are not any questions, then we will accept a motion to accept the quarterly minutes of January 30th, 2020.
This is Fonse. I'll make a motion to accept.
Is there a second?
Kathy Miller seconds.
Thank you, Chair Miller. And then Ms. Strange will need to do a roll call vote.
Brandy Hopkins.
Approve.
Jerry Becker.
Approve.
Christine Babb.
Approve.
Jay Wilverding.
Approve.
Thank you.
Thank you, everybody. Moving on to agenda item number 2. It's public comment. Ms. Strange, have we received any public comment?
We have not. No public comment.
Thank you for that. And we'll loop back at the end as well to make sure if we've received any public comment during today's meeting. So agenda item number 3 is program status report from Mass Mutual. Mr. Gleason, are you on the line? Mr. Gleason?
Bob's currently on mute. I can see him
Okay.
attempting. If you guys have a way to unmute him, that'd be great.
Okay, Mr. Gleason?
Not on mute.
That's what Nancy said. She could hear us, but she couldn't. Okay. It appears we may be having some technical difficulties.
Madam Chair, let me recommend briefly, when we try to figure this out, Bob, on our end, maybe we'll skip to number 4 if Vincent's on the line.
I was going to ask if that's permissible.
Yeah, absolutely.
Thank you.
Your chair, your rules. For the most part.
Well, for the most part, okay. There's a disclaimer about my rules. So agenda item number 4, the quarterly performance review, and we'll go back to agenda item number 3. Mr. Galindo, are you on the line? I see his tagline off to the side.
So he's having the same issue.
We're going to grab our IT folks to get some assistance.
For those with audio difficulties, if you can hear me, at the top of the screen, there should be a menu item called audio. And if you click on audio connection, it should ask you to type in your phone number, and then it would call you. So hopefully that would work for those with some audio difficulties.
Thank you, David. Are either Mr. Gleason or Mr. Galindo able to speak through the audio?
So those of you that are listening, hopefully we've got some connections. Apparently the best way to get through via audio to hear and not hear is to actually dial in as opposed to using your computer. So Bob, hopefully you can hear us and perhaps you can unmute and give it a shot. How about now, Bob?
Okay, now, can you hear me?
Yes, yes.
All right. That worked.
Step in the right direction.
Thank you. Thank you for your patience while we figure all of this out. Okay, so we will go back to agenda item number 3, program status report.
Okay. Thank you very much. You've got several reports from us. There are 2 rollover out reports, and there are 2 quarterly plan summary reports, one for Q1 and one for Q2. I'll start with the Q1 plan summary report, and that is for the time period of January 1st through March 31st. Flipping that open to the first page on the executive summary, just a summation of general plan statistics is what we're looking at. At 12/31/2019, there were about $443 million in plan assets. At 3/31, it fell to $393 million, a loss of roughly $50.2 million. As we all know, the markets took a significant drop in March with COVID-19. Overall, the plan had a slight positive cash flow for the quarter, even though it lost $50.2 million. If you look at the last line item on that page, investment income was actually a negative $50.6 million. So the difference between those 2 numbers represents a slight positive cash flow into the plan. If you look at participant contributions, those totaled about $5.6 million between participants contributing through payroll and rollovers coming in from outside sources. Distributions were at $5.4 million. Kind of a positive on both of those. The contributions were up almost $400,000 from the previous quarter, and the distributions were down about $500,000 from the previous quarter. So those are both good trends. Moving ahead to the next page, on page 3, you see a total participant count. At 3/31, 6,200 employees or participants were in the plan. That's a net increase of 106 participants over the course of that quarter, which is very positive. Average account balance was at 63.4 million, which was down about 9,300. Average number of investment options about 4.3, and then you can see the activity to the 800 number, as well as people accessing their accounts through the mobile device or via the internet. And I'll get into a little bit more detail on the internet statistics later. The next couple of pages show your 457 plan investments by investment options. So you can see in detail the starting balance at the beginning of the quarter, the contributions coming in, transfers, all the activity, and then the end result at the end of the quarter. That first line item on page 4 is the general account. Throughout the first quarter, the general account paid 2.80% interest, and that account started the quarter representing about 37% of plan assets, ended the quarter with about 43% of plan assets. The largest reason for that is the investment losses incurred in all the mutual fund-based investments. There was some money, there was some flight to quality, so to speak, during the quarter. If you look at that middle column, the transfers column, that shows you the activity, whether it's positive or negative, of people transferring money into a fund or out of the fund. And in the case of the general account, about $5.4 million were transferred into that account. So we experienced a high degree of volatility in that quarter, and some people did choose to move their assets into the general account. As a comparison, the previous quarter, the transfer activity in the general account was a positive 166,000. So there was about a $5 million surge into that account. But keep in mind, the portfolio in total is about 400 million or so. So overall, people stayed put, but some people did move. The second largest holding would be your target date options as a collective, those T. Rowe Price retirement date options. If I added up all of those balances, it would represent about 15% of the total portfolio balance. And you can see the activity one by one with those investments as you look down the page. Nothing really jumping out as you look down. Page 5 shows the remaining funds in the portfolio and the investment activity there. Moving ahead, the next 2 pages, 6 and 7, it's the same report, but now we're displaying the 401A plan investment balances. You did see a similar trend. The general account did see a little bit of an increase, transfers going into the general account, about 480,000 going into the general account. This plan is much smaller. It's about 16 million in plan assets. So you had some movement into the general account. That is your largest holding, representing about 25% of the total balance. Target date funds collectively are about 15.6% of the total. And then just below the target date funds, you see the T. Rowe Price institutional large cap. That has about 15.5% of the balance. And then finally on page 7, the last investment option, just worth noting, this would be one of the higher risk investments, Invesco Oppenheimer Gold and Special Minerals Fund. Transfer out of about 231,000, which is roughly half the balance of that fund, was transferred out during the quarter. Moving ahead, cash flow analysis, I'll skip through on page 8. That's just kind of the graphical version of the executive summary we just reviewed. Pages 9 and 10 are showing you where your assets sit by fund and also by the type of participant, whether they're active or retired or beneficiary account holder or quadro. On the far right-hand side, you can see the flow. We look at the last payroll of the quarter, And that's where you can see the percentage of that payroll that actually was put into a particular investment option. So in the case of the general account, just under 22% of the payroll was deposited into the general account. The target date funds, if you added up all those percentage collectively, it's about 48.5% of the last payroll flowed into the target date. So those will continue to grow. They should anyway at a faster rate over time if that trend continues. On the bottom of page 10, you see the counts of how many participants are classified as either active or beneficiary or retired. And not a great deal of movement. Overall, again, 106 increase in total participant count. The actives increased by 93 to 4,121. Beneficiary account holders at 34 was an increase of 1. Retirees at 1,022 was an increase of 8. Terminated at 999 was up 4. And the quadros at 24 remained flat. Looking at balances by age, you can see the chart on page 11, how people are invested based on their age group. And you're seeing what you want to see, which is as people are getting older, they're becoming more conservative. That blue bar, that first bar in each category represents the stable value or the general account category. And you can see that percentage of assets that are lower risk investment are increasing as people age. Conversely, as the younger someone is, the more aggressively they tend to be. And you can also see a much heavier usage of the target date funds. The younger someone is, the more apt they are to use those, which is good. That gives them a very good diversified approach. Moving ahead, I'll skip to page 13. You're looking at participant interactions for the quarter with our call center and with our website usage. Overall, nothing too out of the ordinary. People are looking at a statement of account balance, balance summary. Those are the most common transactions on the website. Balance transfers were 4th. So there was some transfer activity. Again, you saw that increase in terms of dollars going into the general account over the course of the quarter. And the following following 2 pages really are showing you the same chart, but for the 2 previous quarters, if you wanted to compare activity for Q1 versus Q4 of 19, and also Q1 of 19, the same quarter from the previous year, is presented there. So transfer activity was definitely up a little bit. Other than that, there were just a lot of folks checking on their account. The last page is David's activities. David, do you want to take a moment to kind of talk through your activities for Q1?
Yeah, so for Q1, we really started the year off with a great mindset and strategy for seeing a lot of people. And definitely for the first 2 months of the year, our participation was fabulous. We saw we saw 646 people in the first quarter, and we had 29 meetings altogether. 24 of those were our regular on-site meetings. And again, to refamiliarize you with my role, I rotate between all the different departments at the county, and I make sure employees are familiar with how this plan operates and what steps they need to be taking to retire and how to move on to the next stage. So I'll be helping someone enroll, make sure they have the right kind of investments, make sure they understand what the investment choices are and if they're appropriate for them, and then how to move on in their career and make additional changes and whatnot. So this year I did start out the year reaching out to the largest departments and kind of rebuilding the meeting calendar to say, hey, these departments, there's definitely a lot more demand here lately. We want to really try to capture that. And we attacked it right on, and we saw lots of people the first 2 months of the year. So we had 24 on-site meetings. And then when the quarantine stuff started, we had to shift into virtual meetings. And the employees have adopted that very quickly, and it's opened up a whole different group of employees that haven't normally been able to reach out to us for education. So in Q1, we only had 5 virtual meetings, but altogether over our communications and emails and announcements, we had 646 total attendance. So that was a great way to start off the year. And with that, with the education we've been providing over the last few years, I just wanted to add anecdotally, Bob did say that $5 million total went into the guaranteed account, but that was only 88 employees. By and large, of the 6,200 participants, not very many are during that time frame. Not very many were reacting to changes on the account. We're really trying to send the message of being proactive and planning ahead. So it's nice to kind of see that kind of data reflect that people are thinking ahead, they're planning ahead. Most of the conversations I've been having in Q1 when the market volatility began in March, most of the conversations are not what do I do right now, it's what do I do next? What am I doing in the next few years? It's not how do I correct this tomorrow? So a lot of the conversations are really positive, and a lot of the employees are thinking very proactively about how to use this account. So I was very satisfied with how Q1 was. But that's just Q1 data. Are there any questions at this time?
This is a question regarding the transfers. Do we know the transfers are from active members or retired members?
I can sort that right now. I don't want to spend a lot of time on doing that, but there's, if I sort to active, oh boy, I'm sorry, everyone. I don't mean to take too much of our time, but this should only take a moment. Of the active, it was 60 people. So it was 28 retired people and 60 active people. I guess I should clarify, I didn't do the whole time frame. I did from February 20th to the end of the quarter, is what I was reviewing just for my own curiosity, because that was from relative market high through that volatile time frame, and I wanted to see how these conversations I were having impacted things. So it looks like 60 active people, 28 inactive people moved money into the guaranteed account during Q1, from February 20th to March 30th.
Thank you, David. Are there any other questions on the Q1 report before I move on to Q2? No? Okay. How are we for time? Should I speed it up for Q2, or are we running okay?
Well, that would be up to the chair, but while we have a break, Bob, before I answer that question, it's my understanding Nancy Calkins is on the line. Donna, can you try to unmute one of the call lines? We have 2 call-in users. I'm guessing one is Vincent and one is Nancy. Can you try to
Vincent's
unmute
at the
them?
bottom.
Oh, Vincent's there? Oh, okay.
Mm-hmm.
Not sure who the 2 call-ins are, but can you try to unmute one of the call-in users?
Hello?
Nancy?
Hi,
Hello?
Nancy?
Yeah, I'm here.
Okay.
Fantastic. Okay, good. So now we know that we can mute and unmute you, and you are here. So thank you very much.
Oh. Yeah, I've been here pretty much the whole time. I could hear you guys, even though you couldn't hear me. So we're good.
Well, we are working through a few things on our end. So thank you for your patience. And then I will defer back to the chair with respect to Bob's question about proceeding on the agenda.
Okay,
Mr. Gleason,
thank
go
you.
ahead and, thank you. Go ahead and present quarter two.
Okay, thank you. Flipping open the quarter two report in the plan summary, looking at the executive summary on page 2, again, starting the quarter off at 393 million. Really the reverse effect of what we just saw in quarter 1. A gain of about 44.5 million in Q2 caused the ending balance to go up from 393 to 438.6 million. So a $45.6 million increase in value occurred in Q2, which was very refreshing to see. Positive cash flow of just over $1 million. Participant contributions totaled about $5.5 million, fairly flat from Q1. In terms of distributions, they were down from Q1 about 4.5 million or 4.6 million. Q1, the total distributions were about 5.4 million. And when you look at those distributions, we're showing withdrawals and terminations. Just a refresher, the termination number would be lump sums that are going out of the plan, whether it be a rollover out to an IRA or whatnot, but it's a lump sum out where a withdrawal would be like a retiree taking a payment that would be classified as a withdrawal. Plan expenses around 93,000, and investment income again about 44.5 million. Looking at the second page of the executive summary, total participant count was a net growth of 22, so we're up to 6,222 at the end of the second quarter. Average account balance recovered a good chunk of what it lost in Q1, up 7,100 to 70,498. And then again, you can see the call center stats and web usage. Overall, those numbers probably trending a little bit down on the quarter. Looking ahead at pages 4 and 5, we're looking at the 457 balances by fund report again. And you'll see the general account started the quarter representing about 43% of the plan's assets at about 169 million, ended the quarter at about 169.5 million, but now representing about 34.6% of the plan's assets, and that's due to the recovery of all the other funds going up in value for the most part. That transfers column, that column in the middle of the page, if you recall in the first quarter, we saw about 5 million or so flow into the general account. Second quarter, pretty flat. It was about 170,000 that flowed out of the account. So people were not putting money into the general account, certainly in the second quarter, as the recovery took effect. Looking at balances, nothing really stood out here. Your target date funds went from about 14.5% to about 15.4% of total assets. T. Rowe Price large cap growth, the second from the bottom on page 4, went from 10.48% to 12.3% of assets. You could see a substantial investment gain there of 11.8 million in that fund. So strong recovery there. The next page, page 8, shows the remaining funds in the portfolio. Again, nothing huge to note here. Moving ahead to the 401A plan, pages 6 and 7. You see again the balances by fund. General account representing about 23% of the portfolio. Target date's about 16% of the portfolio. The transfer column in the middle, no extreme activity noted there. Page 7, again, remaining funds in the portfolio. Did see another chunk transferred out of that Invesco Oppenheimer fund down, the balance now down to about 82,000 at the end of the quarter. Moving ahead to pages 9 and 10, you see how the dollars are split up by account holder, active versus beneficiary, retiree, and quadro participants. And on the bottom of the page, you see the number of people in each category. Again, not a huge change. The net change was a positive 22. The actives declined by 56 participants. Beneficiary account holders increased by 2. The retired count went up by 41. The terminated count went up by 35. And the quadro stayed flat at 24. Page 11 is the asset allocation summary, where you're seeing by age group how people are investing. No major changes here from the previous quarter. Still seeing the trends that you want to see, which is older participants tend to be more conservatively invested. The diversification charts on page 12, really no changes there. Just a refresher, what we're looking at are the number of investment options held by a participant. In the far left circle chart, what this is saying is the number of options held by a participant. 60% have one investment option. About 23% have 5 or more investment options. And you can see all the selections in between. The percentage of participants that have one option, that center chart, that if that one option is not a target date fund, we're not including target dates, because if their one option is a target date, they're already diversified adequately. So if we remove that category and say of all the other categories, if someone has just one investment, where are they investing it? 89% were invested in the general account. And then looking at the chart on the far right, of those people that are 100% in the general account, how old are they? 78% of them are age 50 plus, which is kind of what you would expect to see. Someone investing that conservatively should be someone typically that would be older. Participant interactions are shown on page 13 for the current quarter, and on page 14 it's for the previous quarter that we already reviewed. Nothing too noteworthy here. Activity is down a little bit. The transfer portion of the chart, which is the green portion, previous quarter was up to about 10%. Now it's down to about 6% of transactions. Since the volatility wasn't as severe and the volatility that was there was in an upward direction, we didn't see as much balance transfer activity. And then lastly, David has his summary of activities. And in the course of the second quarter, we were pretty much limited to virtual interactions. So David, you want to spend a minute and talk about your activity?
Yeah, I was able to shift my calendar to virtual stuff pretty quickly. So this quarter, all virtual meetings, and if we can see on page 15, 33 days in last quarter, so about 11 days a month. It would be me sitting in front of the computer just like this, and participants would either have a web meeting with me, or if their device couldn't do video, then we would talk on the phone or so. But same thing, I would kind of alternate between working with department contacts on having an announcement flyer sent out, or I would have ISD send out an announcement to all employees. I was seeing different ways to see which ways reach people differently. So we're still toying with that to see how many people we're able to meet. But I would sit in front of the computer like this for about 8 hours a day as person after person would come in at their scheduled time. And we had 33 days of individual meetings, but we also had 11 days of group meetings. And this would only be a 1 or 2 hour presentation on some topic. And we had 11 topics all together that people attended. Now, those attendance numbers, people are averaging about 12 people per presentation, but altogether in Q2, switching over to virtual, having employees find these different ways of reaching out to me, we saw 328 people total. So year to date so far, that brings us to, well, I have the number. It's just over 900. It's about 990 altogether. I must have closed the window where I had that listed. But we've had about 990 participants altogether. But Q2 numbers are lower because people, the people I'm interacting with are different people than the normal people that I would see at the HR building or at the HSA building. So I'm finding new people. This is working out for a lot of different people for different ways to interact with me. So again, I think this is going about as well as it can for right now. We're still trying it for Q3 to see if there's different ways we can communicate with people and seeing what presentations are working and are not. But I'm still quite happy with this. And all the conversations and education meetings are pretty normal, but enrollment is lower. In the past, I would always attend new employee orientation, and I'd speak to a group of 40 people, and 15 to 30 of them would sign up on the spot. Hey, it's my first day, I'm enrolling. With going virtual, that process is a little bit different now. So those people are not reaching out to me, or they don't have the willpower to fill out that form in addition to doing everything else remotely. So it's usually the people I'm interacting with. It's just account reviews, moving on to the next stage of where they are in their career, making sure the account is right, saving the correct amount, doing those kinds of things, but less enrollments. So that's something I'll be focusing on as well for Q3. Thank you. Any other questions? All right.
Thank you, David. And then the final item that I had, there were a couple of rollover out reports that we provided for Q1 and Q2. This is something that we started doing last year because we had a couple of quarters where the rollover out activity was in the 4 to 5 million range. And as you can see from these reports, they have come down substantially since then. These are both Q1 total rollovers out. There were 34 transactions totaling 2,695,622. And then for Q2, there were a total of 24 transactions totaling 2,633,780. So activity overall is down from what we were seeing last year, which is good. And we are just showing you where the dollars are going to in terms of what companies they're going to. We did produce a newsletter article and provided that to the Cattails newsletter folks. I believe, David, you had that as well to share with participants. So we are making efforts to educate people on the value of keeping dollars in the plan as they retire to try to reduce the amount of plan leakage that we're seeing. And David, did you have a comment?
Yes, that newsletter, in addition to going out to Cattails, it was included in the pre-retirement seminar that was done in December on site. So that's already been given to 80 active employees that are approaching retirement.
Yeah. And we'll continue to try to keep that message out there of the value of keeping your dollars in the county's plan. There are some real advantages and benefits to it. So we'll continue that messaging as well. So that concludes our reports. Again, happy to take any questions or comments.
Do our committee members have any questions for our Mass Mutual team? Okay, hearing none, we will move on to agenda item number 4, our quarterly performance review from the highest group with Mr. Galingo. Is he unmuted?
He is.
Okay.
Still nothing from Vincent, even though he's unmuted.
Vincent, are you on the line?
He is. I can see him.
Okay.
He texted me and told me to take him off mute, which we did.
Yeah, he's off mute on our end. It's not red.
Vincent, I know you can hear me. Did you dial in on your phone? So he's dialed in on his phone.
Okay. He said he's
Try, Donna, try one of the,
number 7.
try calling user number
He's
7.
called number 7. Yeah.
Vincent,
Can you hear me?
We can.
Hi.
Thank you for your patience.
No, thank you. Let me, okay. I muted my computer since you couldn't hear me, and I think that created some echo. So can everyone hear me okay?
We do not have echo in this room. I think you're good to go.
Perfect. All right. Well, thank you, first of all, for your patience, but also for allowing us to present today. It has been a very, very interesting time in the markets, as both David and Bob had mentioned. I do want to spend some brief moments talking a little bit about the markets with the economic overview, as well as just the major index performance. As Bob mentioned, the first quarter was absolutely bad, concentrated in the last month of the period, with a lot of developments, both from a medicinal or technological standpoint, whether it be tracking of the vaccine, a potential vaccination, but also a clear signal from virtually every department in Washington, D.C., that they're going to use every tool in the toolkit to try and alleviate the economic burden of cities, counties, small companies, American citizens, whether it be the Federal Reserve or the U.S. Treasury or the administration and the legislative branch, really trying to ease the economic pain that we're all feeling. So if you flip ahead, I'm in the report. This is the San Joaquin County 457 deferred comp and 401A defined contribution June 30th, 2020 performance report. If you have that in front of you, go ahead and flip ahead to page 3, if you will. Like I said, I just want to be brief on sharing the broad economic overview. On the top left of page 3, you'll see a measure of our economic output, and that is measured by the gross domestic product. This is the dollar value of every good and service produced in America in any given year. What we've seen over the last several years is a healthy growth of the GDP that averaged about 2.5% a year until the pandemic struck. And in an effort to flatten the curve in terms of infections, we essentially shut the economy down. Certainly there were pockets that were open as deemed essential, but in large part, a large segment of the economy ground to a halt, where we had the first quarter GDP number come in at -5%. I don't know if you've seen the news, but the advanced number for the second quarter GDP number came out this morning at -32.9%. So basically almost a third of the economy was lost in the second quarter on an annualized basis. And this is the weird thing about predictions, or at least economists in the markets. The 32.9% contraction in the economy was actually a little bit of good news. Economists were predicting a contraction of almost 35%. So the 32.9 was relatively good from a relative basis. The chart on the upper right, you'll see the unemployment rate. We were trucking along with an unemployment rate of about 3.5%. Right now, nationally, it's 11.1%. There at the county, the last reading in June, the unemployment rate at San Joaquin County was 15.9%, so a little bit worse than the national average. Moving into the market, so if you flip ahead to page 4, the upper left, this is a brief overview of the bond market indexes. There are about 15 different indexes covering the bond market on the upper left of page 4. I'll highlight just a few of them. The first one is the second line down on the upper left. It's the U.S. aggregate. This is a good representation of our bond market. Historically, the ag has averaged about 3.5% a year. If you take a look at that year-to-date number, it's 6.1%. So back to my point about an aggressive Federal Reserve keeping rates low, thanks to a decrease in interest rates, it's propped up the bond market. And that 6.1% year-to-date number seems like it's so far ago. Right now, as of yesterday, the ag is positive 7.5% year-to-date. Again, that's as of yesterday. A couple lines down, about halfway through that chart, you'll see the U.S. TIPS index. That stands for Treasury Inflation Protected Securities. You can see 6% year-to-date is now 8.0% as of yesterday. And last but not least, about 3/4 of the way down, you'll see the U.S. high yield. The high yield index is a euphemism for junk bonds. Negative 3.8% year-to-date is now positive 0.3. So in recovery in the junk bond space there. Moving forward briefly to the next page, this is the U.S. stock market. On the upper part of page 5, you can see for the quarter the S&P 500, which is a good barometer of the U.S. stock market, 20.54% for the quarter. That's to the positive. Year-to-date is still negative 3.1%. However, as of yesterday, the S&P 500 year-to-date is positive 2.0. So we have seen a recovery since quarter end. And then last but not least, on page 6 is the international stock market. There are about 45 countries outside the U.S. with an investable stock market. On the upper left, we call it the ACWI, or the All Country World Index, or ACWI. The first line on the upper left of page 6, you can see for the quarter positive 16% with a year-to-date of negative 11.0. As of yesterday, the ACWI is still negative, but negative 5.1%. So a little bit of recovery on the international side. So questions before I get into the plan? All right. Hearing none, go ahead and flip ahead to page 9 of the report. I won't go over this in detail because Bob did a good job of explaining the overall structure of the menu of the 457. I do want to call out a couple things, and one of them are some potentially underperforming funds that will hopefully stay in the plan, a couple underperforming funds that we've provided, searches for replacement, and then one vintage of the target date fund that has since been added that the committee can consider for the chair's approval or not. So let me just go back to the point about underperformance. One of the things that we've done as part of this relatively new relationship is take a look at the investment policy statement. And the investment policy statement is essentially the roadmap that the committee, the chair, and certainly your investment consultant looks at on a regular basis to make sure that the metrics in your governance document called the investment policy statement are being adhered to. And we screen those metrics against the characteristics of the funds on the menu. And if there's any issues, we call them out. If there are no issues, certainly we can talk about them, but usually no issues mean no discussion, especially in a packed agenda. The first fund towards the middle on the left-hand side is the Vanguard Mid-Cap Growth. So the distinct asset classes are grouped by boxes, and then they're color-coded with these primary colors. The light blue is the mid-cap. The first underperforming fund is the Vanguard Mid-Cap Growth. But not only has the fund underperformed, but the fund has experienced significant manager change over the last several years. And so the reason I'm calling this out now is because not only is our recommendation to replace it, We've talked about it at the last meeting in January, but more importantly, I just want to frame the context that there's just under $6 million or 1.3% of the assets in this particular fund. Moving into the next box, DFA targeted value. This is a small cap fund. This fund has also underperformed. You can see less than 1% of the assets or under $3.5 million in this particular fund. The other two funds, coincidentally, are on the upper right on the international side. The American Beacon International Fund has 1% of the assets or just under $4.5 million. And then the Hartford International Opportunities Fund, this is a fund that we've talked about at the last meeting. This is another fund that we have provided a search document for possible replacement. You can see $10 million in this particular fund or 2.2% of the assets. And then last but not least, you can see under the orange, the asset allocation header. These are the different vintages of the target date funds, and these target date funds are broadly diversified portfolios that automatically and gradually get more conservative as that target year approaches. Said another way, the 2060 vintage or portfolio is broadly diversified between fixed income, cash, and stock, but it's very aggressive. There's a lot more allocation to the stock compared to the 2020 product. The 2020 is a lot more conservative, meaning a lot more allocation is to fixed income and cash. T. Rowe Price just announced that they added a 2065 vintage. So it's up to you as a committee and the chair to decide if you want to add that. The 2065 is obviously designed for those younger employees, as well as the more aggressive employees who don't feel the 2060 is appropriate. But nonetheless, I wanted to call that out in case there is a desire to offer the full package that T. Rowe Price is offering. So with that said, I'll pause to see if anybody has questions before we get to the four funds that we talked about.
Do any of our committee members have any questions?
Through the chair.
Oh, we do have a question in the room.
Yeah, this is Tammy, and I just, Vincent, would you suggest that we add the 2065 through the chair on our next agenda item or discuss it further now? Because I know we added the 2060 last year.
Right. You can certainly discuss it. It does seem, and I hate to say this as a consultant / vendor, there's very little to discuss. Certainly, if anybody has pros and cons, the allocation between the 2060 and 2065 is very similar. It just makes sense that most committees add automatically, in a sense, all the vintages as the target date provider adds them. So I don't want to, no pun intended, but mute any discussion, but I can answer any questions, but it's more the former, that certainly if there's a desire to add, we can add that to the next agenda.
Thank you.
Any other questions? Before you move on, the little chat box, does that mean we have a question?
Actually,
See a little dot.
if I may, it does, but that was an earlier effort from
Okay.
Vincent to get unmuted, to which I replied.
Okay,
So,
thank you. I just wanted to double check. I saw the dot. Okay. Okay, Vincent, would you like to go ahead and proceed?
Yeah, actually, thank you for the questions and the points. Skipping ahead to page 11, a lot of the data is redundant to MassMutual. So as I said, Bob did a good job. So I'll skip. Bottom right of page 11, you'll see the average account balance popped back very nicely, over $7,300 for the quarter, just under 7,500 for the quarter. So a nice rebound on the average account balance, bottom right of page 11. Fast forward to the 401A plan. Certainly, this is the same menu, different asset allocation and asset levels, given the structure of the 401A plan. But on 13, you can see the 401A defined contribution plan just under 20 million as of June 30 quarter end. And then skipping ahead to page 15, back to my point about the average account balance. This one popped up over $21,000. So given the cash flow characteristics and the market rebound, the average account balance grew by over 21,000 to over 132,000 as of quarter end. As I said, I skipped over a lot of data points, but if anybody has questions, please stop me. Okay, so flip ahead to page 17. I hope I did an okay job explaining or laying the foundation of the investment policy statement and the importance of following a prudent process in the evaluation of the funds. Pages 17 and 18, actually given the size of the menu, it does bleed into 2 pages, but I want to focus on page 17 because this is where the red dots are. Essentially what we do, back to my point about we take the metrics in your investment policy statement that was recently adopted, we screen those metrics against the characteristics of your funds. If no issues, it shows green or P for pass. If there are issues, it shows red for fail. And back to my point is you have 4 funds due to some underperformance, but also 2 funds with some significant manager changes that are violating those metrics. 2 of those funds we have lost confidence in are our recommending replacement. That is the Vanguard Mid-Cap Growth, which is the first fund that's showing red, and the Hartford International Opportunities, which is the last fund that's showing red. The middle 2, DFA and American Beacon International Equity, even though those are showing red, we're comfortable. This is going to sound weird. We're comfortable with the change in the management, but also with the underperformance. DFA was underweight utilities and over consumer discretionary, and over the long term that has hurt them, but over the short term has helped them significantly. So DFA is, even though it's violating metrics, we have confidence that that fund will rebound. American Beacon International Equity is similar insofar that from a sector allocation standpoint, it was underweight financials and energy. It had 0 exposure to emerging markets. Over the longer term, that has hurt them. Over the shorter term, it has helped them. So we do see a recovery of those 2 funds. But back to my point, Vanguard Mid-Cap Growth and Hartford International Opportunities, we did provide search documents for the committee and the chair, and the recommendation is to replace those, but that's further down the agenda. So questions on the IPS compliance report on pages 17 or 18? Okay, in the interest of time, I will skip through pages 19 and beyond. These are the granular data points that trigger the pass or fail. I will skip those. I do have one data point I want to call out on a good note, but certainly if anybody has any questions on those pages, as I skim through to the bottom of page 24, this is one of the funds that is what we call a focus fund, the Invesco Oppenheimer Gold and Special Mineral Fund. I want to call out because of the performance over the years. Bottom right of page 24, you'll see 3 of the 6 calendar years this fund has performed on a positive basis. 3 of the 6 years the fund actually performed on a negative basis. But I do want to touch upon the quarterly number. Given where we are in the economic cycle and in large part due to the coronavirus, precious metals have surged, and you can see that fund for the quarter is up almost 63%. So just an interesting footnote in terms of fund performance. On page 26, if you take a look, I'm shifting gears away from performance to now the economics of the plan. I'll touch upon just the 457 because the 401A is very similar. What we do from an accounting standpoint, it is a fiduciary role, and we as fiduciaries feel that it's our obligation to not only report on the fees, but also monitor them on an ongoing basis. And so we do that in every report as outlined on page 26. And so what we do on page 26 is all the funds on the menu on the left. Towards the middle are the assets for the quarter, and then the expense ratio of all the funds on the menu. And then the administrative tack-on fee, which is a 9 basis point, is towards the middle right. And then through math, what we do is we multiply the assets by those two percentages, and that gets us to the $2 amounts in the right-hand side. So from an annualized basis, you as a committee can see about $1.6 million annually are given to the fund managers to manage the funds on the menu. Just under $400,000 at $394,000 is used to pay for plan-related expenses. And so that $394,000 gets moved into that bottom chart. And because the first plan-related expense, of course, is the Mass Mutual contracted revenue requirement of 4 basis points, that goes to the $175,000, and Mass Mutual takes their cut before they return $219,000 or 5 basis points of the 9 to the plan to use for plan-related expenses. So again, we monitor the fee structure on a regular basis and report to you as co-fiduciaries every time we meet. So, any questions on that report?
Doesn't appear we have any questions.
All right, shall I move to item 5 or pause to just give members some time to unmute?
Committee members, I just want to do one last double check that we don't have any questions about the quarterly performance review before we move on to agenda item number 5. I think we can move forward with agenda item number 5.
Okay, thank you again. So this is the Mid-Cap Growth Fund search and the possible replacement. We discussed this item at the January meeting, and I talked about performance as well as significant manager change. So the document that I'm referring to is now a new document. It's entitled the Mid-Cap Growth Manager Search Report, dated July 2020. If everybody has that in front of them, what we're attempting to do is compare the incumbent Vanguard Mid-Cap Growth with 3 very appropriate, suitable, highly qualified funds and teams. The first one is managed by Times Square out of New York. The other is MFS, which stands for Mass Mutual Financial Services on the East Coast as well, and then Westfield, which is in the Midwest. And so 3 of the funds, as we go through section 2, are some narratives about the particular funds, but really the numbers or the comparison is very, very compelling when we get to page 5 of the report. And so how page 5 is laid out is the top third are peer group rankings. So Morningstar has hundreds, if not thousands, of mid-cap growth managers, and they rank them by percentiles. So the top gets number 1, the bottom gets number 100, and depending on how the fund performs over different time periods, it gets a number between 1 and 100. And those are called peer group rankings, and anything below 50 is shown in red on the top third of page 5. So a little bit of background on Vanguard. Vanguard is a very, very well-known household name in terms of fund management. When it comes to index funds, this is an actively managed fund, and Vanguard does not manage this fund. For years, it outsourced the management to 2 sub-advisors. One was William Blair and one was Chartwell. So looking at the top right of page 5, you can see calendar year peer group rankings. 2014 was good at 24th. 2015, I'm now moving from right to left, was about median at 49th. 2016, you can see the fund was 91st percentile. At the end of 2016, Vanguard actually fired Chartwell and hired Victory Management to manage half of the sleeve, and kept William Blair as the other sub-advisor. Things were going okay in 2017. Some would call it a rebuilding year, but Victory was underperforming in 2017. William Blair was really holding up its mandate. 2018, the fund performed well. And then you can see 2019, the fund finished 63rd percentile. An interesting thing happened. Vanguard then fired William Blair after 14 years of a relationship, even though it had a long tenure, but also was performing well, and then hired Wellington and Frontier. So currently, this fund has 3 sub-advisors, and after talking to Vanguard, we are less confident in the new structure, and that is prompting our recommendation to terminate this particular Vanguard fund and replace it with one of these 3. So I'll pause to see if anybody has questions as to the rationale as to why we're making this recommendation. Okay, so
okay. No, go ahead.
So one thing, and again, if this all sounds familiar, we did talk about this at the last meeting. There are a couple nuances that are important with 3 possible replacement candidates to Vanguard. Times Square and Westfield are what we call CIT. You can see that at the end of their names. That stands for Collective Investment Trust. There is, I want to say, a significant amount of paperwork if you hire a collective investment trust. We would help with the paperwork, but it does add an administrative burden if you were to hire a collective investment trust. To compare a CIT with the other 2 funds, the incumbent Vanguard as well as the MFS Midcap Growth, those are mutual funds that you have scattered throughout the menu. They have a ticker symbol, and adding that to the menu is much easier from an administrative standpoint. There's no paperwork. From a committee or county standpoint, the burden is relatively lower. So as we move through the search document, we'll position the incumbent Vanguard with the other 3. So if you take a look at page 6, the incumbent is the rust or brick color. The top part of page 6 is a scatter plot where we chart risk and return. Our ideal is to get closest to the upper left where we're maximizing return while minimizing risk. The incumbent is towards the bottom right, which is not good. So essentially the return is okay, but the risk profile is relatively significant. The comparison, the Westfield CIT is actually earning more, but it's also taking on more risk. The green square on the top part of page 6 is the MFS mutual fund. You can see that's approaching that more ideal where it is maximizing return while minimizing risk, and the Times Square is somewhere in between. Using very similar data points on the upper part of page 6, we take a look at the Sharpe ratio, and the Sharpe ratio is essentially the risk-free return divided by the standard deviation or a measure of volatility or risk. So what we're looking for are columns that are higher or numbers that are higher. So that green MFS at 0.84 certainly is the number 1 in that particular metric. And then last but not least on this page is the upside downside capture. We look at up markets and down markets and compare how much of these funds capture those up and down markets. You can see Westfield captures a lot of the upside, but it also captures a lot on the downside. Not as much downside capture as the Vanguard Midcap Growth, but again, that's a much more volatile product, hence the positioning on the chart above it. And then taking a look at page 7, one data point is the overall structure of the portfolio or the style. This is a mid-cap growth portfolio, and so you can see on the bottom chart of page 7, there is a significant cluster around the funds over the average. The one outlier is that MFS mid-cap growth. So it is a little bit more growthy than the peers, but also more growthy than the 3 funds that are in the search document. Not a huge deal, but it's just something that we look at to see if we're comfortable with. Section 4 talks about the costs on page 8, and this is where it gets a little bit of a head scratcher because in large part our firm looks at everything, and one of them is the fee as outlined in that previous report. The Vanguard mid-cap growth, as you can see in the middle upper part, charges participants 36 basis points or 0.36% a year. The Times Square CIT is 0.7% or 70 basis points. The MFS is 0.74, and the Westfield CIT is 0.65. So certainly cost does not give a nod to replacing, but hopefully all those other discussion points that I raised earlier backs up my recommendation to terminate Vanguard and replace it with one of these three. So again, I hate to echo what I've been saying, but I'll pause to see if I've explained everything perfectly or if the members or chair have any questions.
Do any of our committee members have any questions?
So after many discussions,
speak. Donna, can you click unmute on, say, perhaps Jerry Becker?
Jerry, we're just checking in that you are able to speak if needed.
I am here.
Okay.
Okay. All right. Just making sure that we're not having any issues with our connections.
Thank you.
Good, great point. Thank you, Jason and Tammy. So we've had some discussions after the meeting around what those administrative hurdles by adopting a CIT look like. And even as I said, they're relatively significant. We've done this many, many times before. Certainly on the pension side of the county's plan, CITs are very common. But with all those considerations taken into account, especially the metrics in this document, our recommendation is to still move from Vanguard mid-cap growth to MFS mid-cap growth. And we can coordinate that with MassMutual. So I don't know if at this point there's a vote. I don't want to be presumptuous, but I also want to be respectful of the time.
So, Madam Chair, if the committee is so inclined that there's a recommendation to replace Vanguard with one of these three options, if you want to entertain a motion, that would be my suggestion if that's the committee's desire, or the committee could choose, and you could choose to stick with Vanguard a little bit longer. I don't know if discussion's appropriate, but that's where we're at.
So before we take a vote, are there, I just want to make sure there aren't any questions from our committee members. Is there a motion to accept the recommendation? Donna, you know what? We may have to unmute everybody.
Yeah, let's try that.
Because they won't be able to speak.
So I apologize to jump in, but just to frame the overall discussion, because at this point, last meeting, Bob raised a good point about the fund change, the communication. I do have in the other business side as well as a second document to go over the exact same exercise, but with the Hartford International Fund. So my recommendation is to also replace another fund, whether it gets accepted or not. I definitely want to respect the committee and the chair, but that's the subsequent agenda item as a second recommendation. So apologies.
So that there's two recommendations in this item?
No, but I wanted to maybe preempt any discussion around MassMutual's point around the fund change. So that was all, not to steal Bob's thunder, but just to frame the discussion around a subsequent agenda. So that was it.
Okay. And Tammy, correct me if I'm wrong, that's what you wanted to discuss during other business?
Vincent?
Correct.
Okay. Then for agenda item number 5, it's the mid-cap growth fund with the possible replacement. If I'm understanding correctly, the recommendation is to move from Vanguard to the MFS mid-cap growth. And that would be what we were looking for a motion on or discussion with the committee if they have any discussion that they'd like to have.
This is Swansea. I'll make a motion to accept the recommendation.
This is Jay. I'll second it.
Donna, do you mind taking a vote?
Okay. Randy Hopkins.
Yes.
Jerry Becker.
Yeah.
Christine Babb.
Yes.
Catherine Miller.
Yes.
Nancy Calkins.
Yes.
Okay.
Thank you, everybody. We will move on to agenda item number 6, the CARES and Secure Act.
Okay, thank you. For this agenda item, I would like to rely also on Bob. Bob, we've done this with other mutual clients, and just having the discussion around this in concert hopefully makes sense, Bob. Not to put you on the spot, but you've been really well-versed on your experience as well. So please interrupt me or correct me if I get something inaccurate or incomplete. So towards the tail end of 2019, there was an introduction of a bill that was probably one of the most sweeping pieces of legislation to the retirement plan industry in decades. But if you remember, towards the end of 2019, DC was focused on a lot of other things. The impeachment of the president got a lot of the news and bandwidth. And then right around the holidays, at the end of 2019 in December, this Secure Act was passed. And it caught almost everybody by surprise, the retirement plan industry, like the consultants and the record keepers, especially. But nonetheless, there were some key provisions. Some were optional and some were mandatory. But the system, because of the surprise, really wasn't built into the platforms. And so we were working through the adoption of the Secure Act. And then the pandemic hit. And really, in large part, virtually every one of my clients, and this is where I'll rely on Bob for his perspective, focused not so much on the Secure Act, but on the pandemic, the work from home, the shelter in place, and then the new CARES Act, which was designed to be some financial stimulus at every level. But that's nonetheless, there are some key provisions in the Secure Act, as well as the CARES Act, that we wanted to highlight. And so with that, Bob, I don't know if you want to add anything or share your perspective.
You know, Vincent, thank you. But my experience has been very similar to yours in that the Secure Act came around first, but the CARES Act just kind of took everything over. So not a whole lot of attention has been placed on the Secure Act. There aren't perhaps as many provisions, but there are some optional ones out there that I think, you know, they're worthy of discussion. And I'll let you go ahead and proceed with that, Vincent, and I'll be happy to interject as we go through it.
Right, thank you. I don't know if the callers have in their packet, for lack of a better term, there's a document, single-page PDF. It's entitled "The Secure Act Key Provisions."
It was sent out to the group.
Okay, great. This is where we can focus on the 457 and the 401A for this particular group. There are a couple sections. One is the mandatory. They're there just to let you know that you don't have a choice, but those are going to be, if not already, implemented. And that's the top half of that document. The second half are the optional. And this is where, again, with the nod to the committee and the chair, this is where you can decide whether you want to implement these or not. And it's not all or nothing. You can decide to adopt some, none, or all. So the mandatory provisions are the RMDs, are the required minimum distributions. That age was increased from 70.5 to 72. Certainly with the CARES Act, RMDs were actually taken off the table. So in a way, that might be somewhat moot for now. The stretch provision, which is really rare with public sector, but that was replaced by a 10-year distribution cap. And then the distributable event for those in-plan annuity options, which you do not have, but nonetheless, those were the three mandatory provisions. Now, unless anybody has questions, we'll move down into the optional, which is the second half of that handout. There is an option for you as a plan to lower the ability for, or lower the bar, the limitation for participants who are still working for the county to take a distribution. We call it an in-service withdrawal or in-service with distribution, essentially lowering that age to 59 and a half. The second provision is if you adopt or give birth, you can take a $5,000 distribution. Back to my point about the annuity options, there is a safe harbor or protection for plans with that in-plan annuity feature, and then a qualified disaster distribution up to $100,000. And that is another optional feature that you can, or similar to the other three, decide not to adopt. And there's no time period if you say, let's hold off, let's re-examine this in the future. That's certainly an option. And the other part too is David working as front with the participants may also have some color on this, because sometimes we do have participants who hear about this either from their spouse or read about it in the news who are saying, hey, is the county doing anything? So I don't know if David has any perspective on any of these, if participants are requesting these.
Yes. Would you like me to share some thoughts, anecdotal thoughts of my interactions with participants at this time, or wait for questions to come in that might be relating to that?
Why don't you go ahead and share a brief overview of what you've heard?
So at the beginning of the year, participants, retirees being able to delay their RMDs, they were quite happy with that provision being added. But we've still received lots of phone calls and messages. Hey, can you explain that? Is that true? Am I really not allowed to have to withdraw the money? Can you prove it? I want to make sure. So there's been a lot of education on that front of trying to explain that part of things. The other parts of it, I haven't had any questions on those yet. I guess with the stretch distributions, there's 36 beneficiaries on the plan right now, but I don't think I haven't heard from any of them. From an education perspective on the optional provisions, right now everything's communicated that this plan is very binary. If you work here, the money stays with this employer. If you don't work here, you're allowed to spend that money. Adding the age 59 and a half provision, it would change how all those communications are given. There would be a lot of employees. There probably would be a lot of interest in people in their 60s withdrawing parts of their funds, but that would really change how this plan is communicated. There'd probably be I could foresee a decent amount of withdrawals, and when employees communicate with each other, there'd probably be a lot of employees that say, well, I want to withdraw my money and I'm not allowed to, and I guess jealousy, or again, communication, not understanding that provision correctly. And the $5,000 distribution for birth or adoption. No one's asked about this, but that's in prior years, these kinds of questions do come up, and I say, well, at that time, no. But I have had employees even this year ask, can I withdraw the money at 59 and a half? Here's language from the CARES Act, and I'd say, no decision made at this time. Or not the CARES Act, I'm sorry, the SECURES Act.
Thank you. We have a question in the room. Tammy?
Hi, this is Tammy. Just to Bob and David, we did send out notice regarding the change in the age for the RMDs, correct?
Yes, to those affected, yes.
Okay, thank you for confirming.
Were there any other questions from the committee regarding either the mandatory or the optional SECURE Act changes?
Are there any recommendations regarding the optional, or are we discussing that option right now?
Vincent?
Yeah, Fonse, I think that was Fonse. I don't know if that question was geared towards me. In terms of the optional provisions, we don't have a recommendation. I think it boils down to, and this is going to sound, of course, but I'll mention it. The first two about lowering the age to 59.5 for in-service withdrawals or offering the $5,000 distribution comes down to a real philosophical stance of the committee. And I've seen some committees that say, Vincent, no way are we going to lower the bar for people working to access more money. It's going to create, as David said, a messaging confusion as well as more leakage. We want participants to keep the money in the plan. The flip side on the other end of the philosophical spectrum is, why wouldn't we offer these? It makes the plan more attractive. It offers participants the ability to make withdrawals. And so we have seen some committees that take that stance. So it really depends on how each member, the chair, and as a committee feel about really what this plan is for. And David raised a good point about the messaging, the participant interface.
For me, personally, again, I guess you would have the two, what you said, the plan. The other side is to allow flexibility for the participant. And again, if these optional items are available, for myself, I would prefer to have the ability to exercise those options. So that's kind of where that's my I wouldn't say recommendation, but that's my thought, and I throw it out to the community to see what they think about that.
Vincent, before anybody on the committee asks another question, I'd like to ask a question. In order to accommodate these options, we're talking about an amendment to the plan document. Is that correct?
Yeah, Jason, Vince, if I could step in and talk a little bit about process. Jason, it's kind of a two-step process. The first step, ultimately, to answer your question, yes, the plan document would need to be amended. But the initial step would be, once the committee decides what provisions you would like to allow, the first step is there's a document, we call it an election of optional provisions survey document that we have. It's an online document that Tammy would fill out, or Brandy, and check basically which provisions the county wants to adopt. Those provisions would take effect, relatively immediately. Within a couple of days, we would have that documented on our system, and they would be made available. Those provisions would be made available to participants. A second step to that process, the plan would ultimately need to be amended, but not immediately. I'm thinking, Vincent, maybe you can help me out with the date. I think for the Secure Act, it was, I want to say 2022.
Yeah, it's at the bottom.
Oh, is it?
You'll see an asterisk. Yep, sorry. Go ahead.
And I'm sorry, what was the date, Vincent?
2022.
Okay. Or 2024, actually, right? Government and collectively bargained plans have until the end of 2024 plan here. So
Yep,
you would
sorry.
have until the end of 24 to actually formally amend your plan. But the initial step would be that election of optional provisions survey document that you would complete and we would have. And then that would allow you, once it's completed, to operate your plan with those provisions that you've selected.
So hypothetically, what happens if we adopt them and then in a year decide we don't need them anymore because the pandemic has relaxed? Do we still need to adopt the plan, amend the plan document?
In terms of process, not sure, Jason. But any amendment, I mean, you can always amend the plan again to not have it included. So there would have to be, I would think, some form of documentation that would have to take place so that it's clear that these provisions were approved, they were allowed, for a given period of time, and then on a specified date, they were no longer a part of the plan.
This is Jay. Can I ask a question? There seems to be some consternation Jason has surrounding amending the plan document. I'm not understanding what that might be.
It's actually twofold, Jay. The minor consternation is process in terms of how long it would take, having to go to the board, having to explain it, having to deal with it. That's the lesser of my concerns. The larger of my concerns is the fact that when we start talking about adopting these federal provisions, potential tax implications, and I am not tax counsel, and I would be very leery of giving any advice regarding CARES Act related changes to the plan document without consulting with someone who specializes in this field.
Tax implications for the county or for the plan participants?
For the plan / the county. In other words, our exempt status being messed with because we did something wrong in terms of enacting these provisions.
Okay, my expectation would be it wouldn't change anything or they wouldn't have put that out there.
That would be a reasonable expectation, but my limited experience with tax law is a lot more complicated than that. And just because it's out there, for example, I'll give you the example of retirement, which is why I'm even raising the question in the first place. In the retirement complex, just because SJ Sarah complies with the SERL doesn't mean it's complying with federal tax law. Those issues arise from time to time. The IRS is its own fun animal, and even though these laws have been adopted, and they've been adopted, in certain cases kind of rushed, the IRS is going to interpret them over time. They're going to look back on things. It's just not something I'm comfortable advising on in terms of what we do. Now, if the goal is to move forward, and that's what everybody wants to do in terms of adopting these things, that's fine. We'll look into it. I'll have to work with HR. If we get to a point where I feel like I need to consult with somebody, I'm going to consult with somebody, and then that necessarily will involve some cost, but it's a reasonable cost if that's the way the plan wants to go.
So here's some things that are rolling through my mind, and I'm going to piggyback on what Fonse said just a minute ago about flexibility, because I agree with where he's going with that. Things have changed dramatically because of the COVID thing. We've seen what's happened with the stock market. We see what's happening with interest rates, and the landscape has shifted, and I don't see that it's shifting back anytime soon. It would be nice if it did, but I don't think we're in Kansas anymore. So where I'm going with this is the additional flexibility. Let's kind of play out where we are now and where we may have been, a few years ago and maybe going forward. So a lot of people pile their money into the guaranteed interest. And when I started here, the GIA was up 4%. It's now down to 2.3. It's probably heading lower. Interest rates are heading lower, and whether or not they go negative is something we could all speculate on, but they're probably not going up anytime soon. Therefore, our earnings in any sort of a fixed income here will probably be limited over time. Somebody may want to take that money out to do something like pay down a mortgage, which, by the way, we're in California and we're all probably in the same tax bracket, give or take, where we're not able to deduct our mortgage interest, our property taxes, our income taxes, or anything else. So having a 3 or 4% mortgage, even if we just refied and we're down to 3.5, is still fairly high above the we'll call it 2.3, I can't remember what it is, in the GIA, and we get no tax deduction for our mortgage. It might make sense economically to pull that money out and pay off your mortgage, because, from a return, a safe return, if you want to call it that, you're better off doing that. And this new change would allow something like that. And that's just one example.
That's an excellent analysis, Jay.
Thanks.
I just think that the options are there. Doesn't mean everybody's going to exercise it. Again, you just have the ability to use it. I think what you will have is question is, well, so-and-so's plan allows it. How come your plan doesn't allow it? I think, how do we respond to that? Again, that's kind of my train of thought.
Well, and also remember that 59.5 Oh, plus, if you looked at the demographic distribution of the county, there's not a lot of people. That's on the tip of the bell curve. It's not like you're going to have a whole bunch of people that are going to bolt for the exits.
Do any of our other committee members have comments that they'd like to weigh in on?
This is Supervisor Miller. I agree. I think we would want to provide as much flexibility for the plan participants as we can. I actually think it makes the plan more attractive. I don't know why we would want to make it more restrictive, or let me say, I understand the reasoning, but I err on the side of flexibility. I think that's more beneficial.
Thank you, Chair Miller. Any other of our other committee members have any questions or comments?
I think what you'd be looking for, then, Madam Chair, would be a motion on what appears to be the recommendations from highest regarding the CARES Act that is in the materials.
Okay.
When we're talking about the mandatory provisions and also the two adoptions, that would be my suggestion.
Thank you. So for the committee, do we have a motion to accept the mandatory provisions and the optional provisions as outlined in this is the Secure Act, the key provisions?
This is Fonse. I'll make a motion to accept the mandatory and the optional provisions in the Secure Act.
This is Jay. I'll second that.
So I want to be clear on the optional, that we're agreeing to all, or the motion is to accept all four and the second is to accept all four?
That is correct.
Thank you. Donna, will you take the vote?
Okay. Brandy Hupkins.
Approved.
Jerry Becker.
Yes.
Christine Babb.
No.
Catherine Miller.
Yes.
Nancy Calkins.
Ms. Calkins, we're going to double check that you're not accidentally muted. Does not appear that you are.
Other than Nancy?
Yes, that's everyone with no Nancy.
Okay, so we'd have a vote of 5-1 with no vote.
We have a vote of 5-1 with a no vote on this particular item. Okay, thank you, everybody. We'll move on to agenda item number 7, the Mass Mutual Survey.
No, wait, don't we have that?
Pardon me?
I apologize. We still, if the chair committee, we still.
I apologize. Thank you. And there is a handout for this as well, correct?
Yes, this document is titled the CARES Act Key Provisions. And similar to the Secure Act, there are optional provisions, but one mandatory, which is included in this document just for context or discussion. And back to the point I was making in terms of really when the economy shut down, the federal government passed this sweeping stimulus package called the CARES Act. 3 of the provisions of this CARES Act pertain to retirement plans, and those 3 are in the document. Just starting with the right-hand side, this is the temporary waiver of those required minimum distributions that I talked about that was impacted by the Secure Act. It's not unheard of for RMDs to be waived. We did this during the credit crisis of 2008. So the waiver is not unheard of, but that's just an FYI. in terms of the mandatory that really doesn't impact you for two reasons. One, because it is mandatory, but two, it impacts people who are no longer with the county. Not that they're still not participants, but again, committees just feel that they're somewhat a little bit more removed. With that said, the first two provisions are optional. One has to do with withdrawals, and the other has to do with loans. Bob, do you want to explain the difference between the two and the features and nuances, or shall I?
Yeah, I'd be happy to, Vincent, and please feel free to jump in at any time. But for the two basic things, the CARES withdrawal provision allows for a withdrawal of up to $100,000 to any qualified individual, and there are qualifications. And I'm sorry, Vincent, I'm just not as familiar with your document. Qualifying conditions are in that second box. Must be diagnosed with SARS-CoV-2 or coronavirus COVID-19 by a test approved by Centers for Disease Control and Prevention. Also covers spouse or dependent who is diagnosed with such virus. Must experience an adverse financial consequence as a result of being quarantined, furloughed, laid off, and or having work hours reduced, being unable to work due to a lack of child care, closing or reducing hours of a business owned or operated by the individual. And then other factors determined by the Treasury Secretary. So if somebody qualifies as being impacted by the coronavirus, they can apply for a withdrawal, and that withdrawal could be up to $100,000. The withdrawal can be repaid if the participant chooses to repay it, or it could simply just be a withdrawal. They can spread the tax liability of that withdrawal over a 3-year period so that they're not taxed on the full amount in the year that they receive it. They can pay the taxes over a 3-year period. They also have the ability to repay that withdrawal over a 3-year period. In effect, it would become almost like a loan. They're paying it back interest-free into their own account. The loans are a little different because the county doesn't have a loan provision. So if the county wanted to allow for a coronavirus loan, first you would have to adopt a loan provision. And what the CARES Act does is it allows for an increase in the limit of a loan. So right now, just a standard loan limit would be $50,000 or 50% of a participant's account balance can be borrowed if you had a loan provision in place. And then if you adopted the CARES loan provision, it would increase that amount eligible for a loan up to $100,000 or 100% of someone's balance. So the CARES Act loan provision assumes you already have a loan in place and you're increasing the maximum limits for that loan. Any questions on that before we go any further?
Just 2 points of clarification. And thank you, Bob. The one thing, and this is either the best or worst thing, is the plan sponsor of the county, the committee, the chair do not have to say that these participants qualify or not. It's a self-certification. If the participant says that they qualify, they qualify. There's no verification. Again, it could be good or bad. The second is regarding the loans. If you adopt the loan feature, the repayments can be delayed up to a year as well. So that's another feature of the CARES Act loan provision. Thanks.
Are there any questions or comments from the committee?
This is Fonse. Do we have any recommendations from the consultant?
On the bottom, it looks like, and I'll turn it over to Vincent, it appears they are recommending adopt. There's a final row at the very bottom of that page.
Thank you. Yes.
This is Jay. I'd like to share kind of my thoughts. I'm going to flip on the other direction from my last comments. And I think this does exactly what, and I forget if it was Vincent or Jason mentioned, but I think this is kind of going in the other direction of what we're trying to accomplish by getting folks to save and whatever. I especially don't like the self-certification thing where anybody could just claim anything. We saw where that got us back in the early 2000s with loans. I think this is opening a Pandora's box.
Are there any other comments from the committee or questions?
This is Jerry. I agree with the points that Jay made. However, I would take the position that this is the employees' money. And at the end of the day, if they have a desperate need that we're unaware of, I think they should have the right to tap into their own money.
This is Fonse. I definitely share Jay's concerns, but just kind of being consistent with, again, with my thought process. No matter how, even if we don't like it, again, I like the idea for the flexibility for the employees.
Any other committee comments or questions?
I have a staff question, Madam Chair. What's involved, if you guys know, Vincent or Bob, in terms of administration when it comes to not so much the withdrawal, but the loans? Who handles that? Keeping track? Is that purely benefits? How does that affect the auditor? I'm curious what you can.
Yeah. Yeah, this is Bob. If the committee wanted to adopt all the provisions of the CARES Act, I mean, my suggestion would be to first move forward maybe with the withdrawal provision to allow that. And I think the county should put a loan provision in place first. I mean, you do have to have that in place in order to even administer a CARES loan. So I think step one would be allow the distributions, and then agree to add a loan provision. That does require, adding a loan provision requires an amendment to your plan document. And we'd have a loan policy that goes with that. And then from there, once you have a loan in place, a loan provision in place, you can come back and you can adopt the CARES loan provisions on top of it. But first, you want to have a loan provision in place, and that may take a little time, especially if you need to put that through for board approval for the plan amendment.
This is Fonse. What are our comparable counties doing? Have they adopted similar provisions or
Yeah, I would say most of my plans have done something relative to CARES. At a minimum, the withdrawals are approved, and I would say most have also adopted a loan provision as well, but they already have a loan provision in place. Most plans already have that loan provision in place, so adopting the CARES loans really just increases the limit of a loan provision. So you really need to have that loan provision in place first before you can adopt the CARES loan provision.
So I would say probably half of my clients have adopted, the other half have not. The ones that have is, again, it's more the philosophy of this is their money. This is a once in a lifetime pandemic. we're going to offer them access to their own money. The other part of it too is it boils down to what the David McRae's of their plans are saying, because again, given his interface with the participants, they may be asking for it. The flip side is the other half are saying, you know, philosophically, no, we don't want to lower the bar to access their money, or, which is probably more common, is let's just wait and see. No one's really asking for it. There's no time limit on this per se. We can always adopt it at the next month, the next quarterly meeting, whatever. So we're going to hold tight, but it's 50-50 in my book.
Is the county getting a lot of requests for distributions or loans because of the CARES Act?
Bob, are you asking me? This is Tammy.
Yeah, you or Brandy or yeah, whoever.
I have not received any phone calls. I think maybe David would be a better judge of this.
We have, I have not, there have been a few employees that have asked about it. Hey, I've heard on the news that there's this provision to withdraw $100,000. Can I do it? And I would say, no, the county has not made a decision at this time. Usually when that conversation occurs, and it's only been a few times, there's still the hardship provision. Employees can still try to qualify for a hardship as well.
And this is Tammy. Just for the committee's information, the the hardship withdrawals are not done through the county staff or personnel. It's all done through Mass Mutual as our record keeper.
So if we postpone on making a decision, if an employee were to approach us, we would say, let's wait till the next quarterly meeting so we get it approved for you. Is that what I'm hearing?
I think that the answer would be we currently aren't offering it, and we could include that we were looking into it, and certainly keep their information and come back to them should the committee decide to offer it at our next quarterly meeting.
Fonse, I'd just like to remind the committee, it is advisory. If it became such a major issue between now and the next quarterly meeting, the chair, as plan administrator, could act unilaterally to, make a decision and say, hey, we need to start doing this. And then, of course, she'd report back to the committee. But if it postpones to the next quarterly meeting, HR can still deal with it.
So this is Brandy, and I think from my perspective, from what I'm hearing today, it sounds like the committee does want to look at offering flexibility to our employees and to plan members, but maybe we need to digest this a little bit more and look at pros and cons. And that's an item we could bring back next quarter if that pleases the committee, and put some more information with this to you. Are there any thoughts about what the committee might want to entertain today?
Brandy,
it's not as easy when I can't see your faces. Jerry, go ahead.
I'm just concerned about, we have multiple members of our team here in the county who have, 2-income households. It's hard to know what things they're facing. I again, would just like to give them the maximum flexibility for access to their own money.
So, Jerry, I echo your sentiments, and even though we haven't heard from members recently, from an HR perspective, I am concerned with school closures, that there may be some 2-income families in our community that go down to 1-income families, and they may need some assistance during this time.
This is Supervisor Miller. I agree. I think, especially to be consistent, I feel that we should be providing as much flexibility to our plan participants as possible. This is just a massive event that has occurred, and we can't know how it's impacting all of our participants. But the bottom line is it is their money, and I would like to err on the side of providing access to it if they need it.
Thank you, Supervisor Miller. Are there any other comments or questions from the committee?
This is Swansea. I share the same thoughts of Supervisor Miller and Jerry.
Thank you. County Council, should we take a vote?
Well, unless there's a motion on the floor, I don't think a vote.
Oh, I'm sorry. I meant the motion.
No, that's fine. But even if there were a motion, I think, especially with the loan provision, which is going to require a plan document revision, I think just the general direction of the committee to explore these options, HR and you as a plan administrator, to explore the options and put together a plan. And if you can perceive, you can get it in place before the next quarterly meeting. It sounds to me like you have the committee's blessing and its direction. If somebody wants to make a motion, they can, but I think you have what you need to proceed.
Thank you. Then we will proceed, and we will update the committee as we work through this process. I think that means we're ready for agenda item number 7, the Mass Mutual Survey.
And in terms of the survey, the committee looked at that during the last meeting. The survey was approved. We did some final compliance approvals. Tammy had a chance to review it and test it out. We have since distributed it to the population. It's actually live right now. Participants have until July 31st, tomorrow, to complete the survey. So the survey link has gone out electronically. The county has sent it out, I believe, twice. They've given 2 notices out to employees. And I know David sent out the link to those participants who are no longer employed, who we have an email address for. So we've gotten the link out. We've encouraged participation. The survey closes tomorrow, and we should have results from that survey at the next committee meeting.
Thank you. Do we have any indication of how many people have responded so far?
I do not at this time, no.
Okay, thank you. Are there any questions or comments from the committee? Tammy?
Sorry, through the chair. Bob, I would like to extend the survey if the response has not been very well received or responded to. So how can we find out the response rate?
I could look into it, Tammy. I should be able to find that out easy enough. And it would be easy enough to extend the date. It would just require another communication to go out to folks to let them know that it's still out there.
Okay, yeah, I would appreciate that.
So I can connect with you later on this afternoon on that.
Okay, perfect.
And Tammy, perhaps we could ask ISD to send something out today as well.
Yes.
Sometimes if we do that, tomorrow's the last day.
Okay.
We might get some last-minute response. Okay, thank you. So moving on to agenda item number 8. Is there any other business that the committee would like to bring up, or any of our other participants?
Yeah, so again, not to pile on, but just in the interest of time, I do have that international search that I'm ready to present, or in the interest of time, I know my clock says 11:58. So I will defer to the chair and the committee on whether you want to entertain the review of the search and a subsequent replacement or table it.
Madam Chair, I'm going to interject. It's having looked at it and now understanding what it is that we're talking about, I don't think it would be appropriate for the committee to address it at this time because it's not on the agenda. So while you can certainly talk to Vincent about it, Vincent, I do want to ask you one question. How urgent is this potential fund replacement?
That's tough. I would say on a scale of 1 to 10, when 10 is absolutely urgent, I would say 7, if that helps. Our recommendation is to still terminate, but we could push this out into an interim meeting to the next meeting.
Okay, that's what I was looking for, Vincent. Again, and so Madam Chair, my recommendation is it would be inappropriate to discuss now. You and Tammy and Vincent can decide whether an interim meeting is appropriate, action is appropriate, but in terms of having it discussed at this meeting, I would say no.
Thank you. Then we will hold on that and we'll get back to the committee with whether we need to do an interim meeting or if we can hold this to our next committee meeting next quarter.
Perfect, thank you.
Yes,
Can I
Christine?
say something? Hi. We were talking about doing this combined so Mass Mutual wouldn't have to send out two notices that we're changing this, and then a few months later we're changing this. I thought we were going to make sure that they would be together.
I just want to make sure I understand your question. Is your question that you thought this was going to be covered in the other agenda item, or?
No, I'm sorry, I'm not being clear.
Oh, you are. I'm sure you're being clear, and I'm not understanding.
So actually, if can I interject, please? Because I think you're spot on. There are two potential issues with staggering, and it has nothing to do with the urgency of one fund change over the other. The two aspects are just the two fund changes happening back to back and the noise that participants would experience. It could be high or it could be a non-event, but basically two fund changes back to back could be potentially troublesome. The other point of it, and this is where I was going to say, Bob mentioned at the last meeting that there is a fee for fund changes. And so coupling them for those two reasons made sense. It's not urgent. That's why my urgency went from a 6 to a 7 based on the two things that I think was raised just now that I interrupted. But I would agree with the last member and her comments. So did that help?
And I'll just interject one thought here is if the committee wanted to have a special meeting in the near term to discuss a second fund change, we can certainly hold off on implementing or processing the fund change that was agreed upon today, have that second meeting, make the decision on that second fund. That way we can implement them jointly, have a joint communication that covers both fund changes. And if everything is done quickly enough, what we did last year, just a reminder, there's a National Retirement Security Month is coming up in October. And if you all recall, we sent out an announcement where we did a fund change, and we also announced some educational activities around National Safer Retirement. It was Safer Retirement Week last year. This year it's Safer Retirement Month. So we can also use that communication as an opportunity to let participants know about educational opportunities for the plan coming up in October. By putting all that into one notice, by the contract, Mass Mutual covers one fund change announcement per year. If you had two fund change announcements, I think that's the comment that Vincent had earlier. The second one would be at the county's expense. And I don't believe we've had any fund changes yet year to date, so I believe this would be the first one. If that's the case, it would be covered by Mass Mutual.
So based on my advice about not discussing the item and Chrissy's concern, I would recommend that an interim meeting be planned, that we could even do it by phone. I think it'll be smoother than it was this time. We might not even have to do WebEx. That would be appropriate.
So we wouldn't have to make it like a public meeting?
No, it has to be a public meeting, but we can do it purely by teleconference. That's something we can work out, but I think we can do it fairly easily, and that then the committee will have a chance to appropriately speak in public about this item. So
we will follow County Council's advice. We'll work quickly to set up an interim meeting and have the discussion about the international fund. Was there any other business from any of our other committee members?
This is Nancy Calkins.
Yes. Ms. Calkin?
So I just wanted to say that I've been connected to the meeting the whole time, but I think there's been some times when you couldn't hear me, and one was for a couple of the votes. So I just am registering that I've been here and have listened to everything, and I'm fine with the way votes turned out. So I don't know if I need to be recorded or not.
No, but duly noted. And thank you so much for your patience and everybody else's patience while we figure out how to do these meetings remotely.
Hey, no problem.
And again, sorry, just one last apology to Christine. Sorry, I didn't mean to interrupt, but I thought your point was spot on. So apologies.
Yep.
Thank you.
Yep.
I couldn't figure out how to make it sound better, so thank you.
Thank you, everybody. We're going to do one last call for public comment in case any public comment came in during the meeting.
There has been no public comment.
Okay, there is no public comment. So with that, we can adjourn the meeting at 12:05. Thank you very much, everybody. Have a good day.
Thank you. Bye-bye.
Thank you.
Thank you very
Bye.
much. It was an excellent meeting. Thank you. Bye-bye.
Yes. Bye-bye.